In this video, guys, we're going to look at why does the market know where my stops are? Stay tuned. Hey traders, warm welcome to you. All right, so why does the market know where my stops are? This seems to be the rallying call from many newer traders. Like, the market knows where my stops are, keeps moving to them, stopping me out, and it does feel like that, right? You place your stop, the market goes there, just goes ping, I'm just gonna take your stop and I'm gonna carry on in the direction you wanted. You just go, you're just getting so frustrated and you think, hang on, this is a conspiracy, man. Am I the only person here? Why do they know where my stops are? Let's kind of look at this situation. So if we will go back many years to the trading pit, then brokers and order clerks would know where your stops are because you'd place them with the broker and they'd have a stack of cards and the cards would be in order of price. So they'd go in kind of incremental order if it goes to the upside, etc. And well, as price would get to it, they would execute the orders. So the order might be, hey, Mark wants to sell 100 contracts at 1,500. Great, sell 1,500. Tell him it's the fill, he's been filled at 1,500. Great. It might say, Julie wants to buy 25 contracts at 1,501. And it's a stop order. But you don't know if it's a stop order per se, but you would see where all this liquidity is. And so they would know, hey, Julie's got an order, and they say, actually, Ben's got one, and Chris has got one, and John's got one, and Jane's got, there's a big cluster of orders here. Now, the thing is, as a pit clerk, you would, or as a pit trader, as the market went to that position, you would be able to lean on this order flow because you knew that, hey, someone was there to sell or to buy. And so, you could, the market would move into these directions because the pit guys would know where these buy orders were, and they'd know that those buy orders would probably trigger a further move. And they know that, hey, in the day, if you can buy just in front of a flurry of stop orders or even way before, then as it hits those stop orders, you've got to execute those stop orders. And you can execute them to yourself. In the day, that person who wants to fill, don't care who's their counterparty. And so very often what I'm trying to say is that the market would stop hunt. And you would see the pit guys pushing the market to hunt for the stops because they knew the liquidity was there and they knew exactly where the stops were and they knew that would cause the market to flurry up and down. Now, I'm going about this a long-winded route if you're still with me. So that did go on. Stop hunting went on. Now, stop hunting in the current market, the jury's out, and some people say, hey, you know what, the market will go and move stops. I'm not a big believer in that. I tend to think that the reason that stops get hunted is just by the nature of the way the market is moving. Because everybody is long and their stop is below the low, who's left to buy? And why would anybody want to buy higher? Everyone wants to buy lower. That's the whole point. If you're, especially an institution, now it's slightly different for a trader because you maybe waiting for confirmation and stuff, but institutions, I want to buy this asset at the cheapest price possible, within reason. They don't want it going lower because the thesis has changed, but they want a cheap price for the asset they're buying. And so if they see that, hey, the momentum stopped, there's no buyers, then why would they not wait until they can find a price they want? That's a subtle difference, guys, between, maybe retail institutions. Institutions wait for price to come to them. They're not chasing price. And so because everyone's kind of bored, if we simplify this extreme, I know I'm simplifying this, and probably you guys are going to give me some battering potentially in the comments for this one, but if we simplify it and say, hey, everyone's now bought, then the demand has disappeared. And so supply naturally brings it lower. If everyone's got their stop below the low, that all gets triggered, bang, that's the peak of supply. And then why does it reverse? Well, because supply has suddenly stopped. All the stops have been triggered, and then we'll sell in. And then often it kind of evens out again. People think it's a good value and it pops back up. So it's almost a self-fulfilling prophecy in some instances because the market will tend to move towards liquidity just because it's supply demand based. If everyone's already bought, that's taken away all of that demand. And unless there's fresh demand coming in, which is where we get trending environments, some kind of catalyst, etc., more people buying, more people buying more, then just by the nature of it, that's going to cause an equilibrium. If demand backs off, maybe it's supply coming in, and it just changes the nature of the game. The supply comes in, it then drifts down towards the low. There's a sudden flurry of supply with the stops, and then it kind of equalizes again and comes back. So it's just this ebb and flow and stuff. Anyway, what does the market know when stops are? Because very often This is a second point. Very often, many traders are putting them in what they consider to be technically sound places. Now, listen, there are times under certain conditions when you absolutely want to put your stop in a predefined place under a low or something that's relatively normal, because the thesis of the trade, your thesis is that there is about to be a flurry of momentum in your direction. And so you can put a stop just under the levels that we talk about how to jump on this type of thing, because the whole thesis that it's going to rip, and if it comes back, you don't want it. That's different. If you're trading in a range bound condition, let's say this, for example, people say, you know what, you put your stops above the high, below the low. That's where my stops are going to be. I'm going to put it here. I'm going to short it when it comes back up here. I'm going to buy it when it comes back up here. And yes, that is sound logic. It's a mean reversion type trade. Very, very useful type trade. There's your mean reverting back. Market's bit stretch, comes back. Market's bit stretch, comes back. Fine. Makes perfect sense. However, very often, because of what we've mentioned, supply-demand imbalance is tipping and tipping and tipping, the market's going to probe. And the market will probe because it's just literally no demand. Some supply will come in, and then it will encourage more buyers coming because they feel like it's a good value, and it'll pop back up. So that's why we often get probes above highs and lows. It's hunting for supply and demand. Is it orchestrated? I don't think so. I think it's purely the nature of the beast. So how do you combat this? Well, the first thing is widen your stops. I know that the challenge with widening your stops is that risk order ratio then gets skewed. If you have your stop right up here and you're looking for mean reversion, it's a 1-to-1 if you're lucky. It's not worth it. The reason that's so useful is also tempting is that it's maybe 2-to-1, 3-to-1 risk order ratio, and you can put your stop there. Okay, so that's maybe not a solution. Maybe it is for some scenarios where, let's say you think that this is going to break out of a range up and it's going to hit the target here. It's come up in this kind of direction before. That might be slightly different. You can have a wider stop because it still accommodates your target. However, a better thing to do is to just be a little bit more thoughtful about trading against the crowd. So why don't you start to enter where you would normally put a stop? So when a textbook says put your stop, why don't you enter there? And sometimes it can be a little bit frightening, because you're stepping right in front of all this. You're like, this is where I normally put my stop. But actually, you'll find that this becomes a very profitable strategy, because if you are in the right conditions, the right scenarios, there's so much more to this. But on a broader basis, if you're there stepping and you're basically filling those stops for the retail crowd, you're probably going to be on the right side of the market. Maybe not long term, but initially enough to get some off the table and scale and hope to hold some for a longer move. So actually having your position in a place where you're not going to get filled all the time, of course, but that doesn't matter, because if it doesn't fill you, it doesn't fill you. And when it does fill you, you kind of go, okay, well, I'm going to put my buy order here and I'm going to put my stop here. So you're literally taking your whole order and trade thesis from being kind of at support and stop here and just dialing it down to where your stop is. You just move the whole thing down. Now, you might not get filled, etc. But what this does is it captures that wick, it captures that little flush, it captures that vacuum in the order book that we often see. If you're watching level 2 or market depth, you see that flushing through lows, book goes thin, bang, 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 bang. It just stretches through, leaves a vacuum, that price comes back up, people start filling the order book back up. That's when you get your wicks. It depends on the asset you're trading with that. But the point is, guys, is that if you can use it as your advantage, so if you're constantly getting stopped out all the time, you're saying, hey, why does the market know where my stops are? Use it and say, hey, well, actually, if I bought where I put my stops, and I know it's a simplistic way of thinking about it, but you can work it out from there. If I did this, my results would change massively. So why don't I try to do that? Why don't I try to find and look where would the textbook stops be and consider buying there? Of course, still manage your risk. Still have a point where you come out if you're wrong. You're not just going to blindly add to the position, but you can use it to your advantage. You can think, hey, this might be just because we're quiet, volume's low, supply, demand, ebb and flow. Where would be the point where we get a peak in demand or a peak in supply that, if we were still in a range-bound mean reversion environment, would perhaps unwind and we get pulled back? If you can pinpoint that, then you start to really get in tune with the market. Good for scalping, good for day trading, for swing trading as well from a certain perspective, when the markets are quiet and stuff, but definitely good for you kind of intraday traders out there. Anyway, hope that's made some sense. There's a lot going on in my mind. I hope that I've kind of explained it in a way that helps. If not, let me know. Maybe do another video a little bit more in depth about it. But if you like this kind of stuff, a thumbs up is appreciated. Take care. Bye-bye.